Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending June 2nd, 2023. Looking at the market indexes for the week, the TSX, S&P 500, NASDAQ, Dow Jones, and Russell 2000 were all up, mostly after a strong U.S. jobs report and the U.S. Senate passage of the debt ceiling bill, which will avoid government default on their debt. Gold was also up, as was oil, up to about $72 per barrel for the week. Turning to Canada, the Canadian economy remains resilient despite aggressive rate hikes from the Bank of Canada. On Wednesday, in the GDP read for Q1, Statistics Canada said GDP grew at an annualized rate of 3.1% in the first quarter, so 0.8% for the quarter itself, beating the agency's 2.5% forecast and still nowhere near a recession. Household spending on goods and services was up after being flat over the previous 2 quarters, and higher exports provided additional cushion. Conversely, disposable income dropped for the first time since the fourth quarter of 2021. Historically high interest rates are making the Greater Toronto Area condo investing a lot less lucrative. A new report from CIBC and Urbanation found more than half of pre-construction investors with mortgages are losing money every month. Only 48% are churning a profit from rent after accounting for condo fees, mortgage costs, and property taxes. The report's authors expect the situation to persist as expensive pre-construction condos get built. They say investors will have to hold on to their negative cash flow units as long as they keep getting financing and prices rise. On average, the 52% of investors that were losing money were losing $223 per month in 2022, but that number varies greatly. Some investors were cash flow negative by $1,000 every month. This could have implications for the rental supply in the city since investors play a big role in condo development projects. Without demand from them, developers might build fewer condo towers, leading to even lower rental housing supply. Oil prices retreated or stayed flat during April and early May as concerns over the health of the global economy and oil demand prospects depressed market sentiment. These trends contrast, though, with the tighter market balances analysts anticipate in the second half of the year, when global oil demand is on course to eclipse supply by almost 2 million barrels a day. This bodes well for oil prices in the coming months of 2023. The oil and gas industry benefited from an unprecedented cash windfall in 2022, but most of this has gone to dividends, share buybacks, and paying back debt, rather than into energy investments, which is the reason why energy demand will be eclipsing energy production. But it has been great for investors, and only a small fraction of the windfall has been invested in clean energy technologies. The industry can do far more to scale up clean energy options like renewables, low emissions fuels, hydrogen, and carbon capture, but it is staying where the money is for now. Real per capita spending growth is falling in 7 of Canada's 10 biggest cities. Ontario and much of Western Canada are witnessing slower spending relative to Atlantic Canada, possibly due to the high interest rates and the high mortgage debt. Canadians' consumer confidence is the highest in 2023 based on the stabilization of interest rates and Canadian real estate. The higher rates are thought to be the new normal. And finally, for Canada, the United Conservative Party, UCP, won in Alberta this week in the provincial election, which looks to be good for oil companies. Turning to the United States, the US added 339,000 jobs over the expected 180,000, which means the US economy is still strong, with wage inflation not expected to come down, both because of the job numbers and the year-over-year wages up 4.3%. Further interest rate hikes just became likelier in the US. The US government made a tentative debt ceiling deal over the weekend of May 27th, and finally, on Thursday this week, the economic crisis has been averted in Washington for now. President Biden and the Republican Speaker of the House, Kevin McCarthy, struck a crucial deal this week to suspend the debt ceiling until after the 2024 presidential election, after Treasury Secretary Janet Yellen warned that the country was at risk of running out of money on June 5th. The U.S. Senate passed the legislation late on Thursday to suspend the government's $31.4 trillion debt ceiling and enforce restraints on government spending until the 2024 election. The U.S. JOLTS data had U.S. job openings increase 358,000 to 10.1 million and higher than expected in April, and layoffs dropped to 264,000, although voluntary quits increased to 49,000. It's not clear exactly by how much the excitement about AI has boosted stock returns in recent weeks. This chart suggests that the rough answer is a lot. The S&P 500 is about 9% up year to date, but if we remove a basket of 11 of the largest AI exposed companies, the rest of the index is down by about -7%. But AI is certainly an important part of the story, as evidenced by NVIDIA's impressive results recently. It could be many investors may still be underestimating the potential of AI. U.S. mortgage demand is at its lowest point in 3 months, according to the Mortgage Bankers Association. Rates shot up again recently, nearly hitting 7% by some measures, as it became clear that the Federal Reserve was not going to cut its benchmark rate anytime soon. The supply of homes remains tight as well, and prices look like they're going to go higher again. Quote, while refinance demand is almost entirely driven by the level of rates, purchase volumes continues to be constrained by the lack of homes on the market, end quote. Michael Frattoni, the Mortgage Bankers Association chief economist, said in a release. More and more companies are looking to bring manufacturing operations home, pulling out of long-standing production powerhouses like China in a trend called reshoring that could have massive implications for the global supply chain. According to Bank of America analysis, mentions of reshoring during the S&P 500 earnings transcript in the first quarter were up 128% over the same quarter last year, outpacing even the growth of the mention of AI. Quote, there's a host of factors at play here: the Russia-Ukraine war, the after effects of the COVID-19 pandemic, US and EU incentives for the at-home production, and shifting demand due in part to the rise of TikTok. Still, remapping the global supply chain won't happen overnight. Now for some bits and pieces. The recovery in China post-COVID has come into question as disappointing factory data stoked worries about the country's slow post-pandemic recovery. The National Bureau of Statistics said Wednesday that China's factory activity fell to a 5-month low in May, contracting even faster than expected. Also, service sector activity expanded at the slowest pace in 4 months in May. Investment in clean energy technologies is significantly outpacing spending on fossil fuels, as affordability and security concerns triggered by the global energy crisis strengthen the momentum behind more sustainable options, according to a new IEA report. About 2.8 trillion US is set to be invested globally in energy in 2023, of which more than 1.7 trillion US is expected to go to clean technologies, including renewables, electric vehicles, nuclear power, grid storage, low emission fuels, efficiency improvements, and heat pumps, according to the IEA's latest World Energy Investment Report. The remainder, slightly more than 1 trillion US, is going to coal, gas, and oil. Annual clean energy investment is expected to rise by 24% between 2021 and 2023, driven by renewables and electric vehicles, compared with the 15% rise in fossil fuel investment over the same period. But more than 90% of this increase comes from advanced economies and China, presenting a serious risk of new dividing lines in global energy if clean energy transitions don't pick up elsewhere. On the investing front of energy, announcements of new manufacturing projects for several essential technologies for the clean energy transition, including solar, PV, batteries, and electrolyzers, have accelerated in recent months, highlighting the growing global momentum behind the new energy economy. IEA's recent analysis also shows. Since late 2022, the estimated output by 2030 from existing and announced manufacturing capacity for solar PV has increased by 60%, for batteries by 25%, and for electrolyzers by 20%, propelled by policy support and growing interest from investors. Finally, turning to next week, companies reporting next week. On Wednesday, we have Dollarama, Thursday is Saputo and DocuSign, and on Friday is NEO. Economic events next week. On Sunday is the last day of the OPEC meeting. On Wednesday, we have a Bank of Canada interest rate announcement, which is expected to either hold or possibly increase 0.25%, about 50-50 chance. We have US oil inventories as well on Wednesday. On Thursday, we have initial and continuing jobless claims in the US. And on Friday, we have the Canadian unemployment rate for May. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.